All right, so I think it's about our time for starting. Thank you all for coming. I'm Andrew Dowell, I'm the Asia editor for the Wall Street Journal. And we are here to discuss, in the words of our hosts, whether the rise of megafirms is prompting digital markets to shift toward a winner-take-all dynamic. I think that's basically a polite way of saying, are Google, Facebook, and maybe Amazon a problem? And if so, what should be done about that? Just to start out with just a word of disclosure, of course, I'm from the media industry, and the answer for us is pretty much yes. We compete with these platforms not always very well for users' time and attention, for advertising dollars, and obviously just for sort of mind share. Also, my own particular company's leadership has been pretty hard on these companies publicly. It's not my place to engage in that, so I just hope that you'll understand that whatever we talk about here today will be independent of their content, of their comments. So just to kick things off, obviously it's a very complex subject. A colleague of mine reminded me recently that you used to have to go to a special room at the telecom company in a lot of countries if you were going to make an international call. It was like fantastically expensive and almost impossible to do. But of course now it's free and easy to send voice or text or photos thanks to Facebook. And the same is true of Google. I made a boneheaded decision a few years ago to take my family on a vacation from Barcelona to the south of France, and it was boneheaded because I have no idea how to get from Barcelona to the south of France. But Google Maps saved me, and again, it was free. And it did occur to me at the time that if that service had been provided by a telecom company, it probably would have cost thousands of dollars. So, there are obvious upsides to these big companies that are able to do lots of different things. But it's not all upside. These companies mediate an awful lot of economic activity, whether it's in getting cabs or finding your way around the internet or connecting with your friends. There are these companies have a pretty tight lock on users' time and attention, on advertisers' dollars, and there are obviously a lot of concerns nowadays about what goes on these platforms. And as a result, in the U.S., in India, in Australia, in Singapore, in the UK, and Europe, regulators are starting to pay attention and starting to look at the problem. So what we're hoping to do here is just to get into a deeper discussion of what's going on in the marketplace and what some of the reasonable or most reasonable solutions might be. So I'd like to start with Arun. Arun
Yes.
Sundararajan, you are professor at the Stern School of Business at New York University.
Yes.
Author of The Sharing Economy, and a noted expert on digital economics. Could you just talk to us a little bit about how the kind of new tech monopolies, for lack of a better word, compare to some of the old line monopolies? And are they different, and do they bring a different set of of harms and benefits?
They are different. I think that there's no doubt that today's tech monopolies are not the same as, say, Standard Oil. But I think they're different in different ways. Not all tech platforms are created equal. We often associate network effects with these tech platforms. And over the last 20 years, I've grown to realize that network effects are among the most coveted, the most revered, but also the most misunderstood concepts in the tech industry. The network effects that Uber and Didi have are very different and less powerful than the network effects that, say, Alipay or Facebook or WeChat have. I think to answer your question, the design of digital technology makes monopoly far more likely. There is something intrinsic about how the technology machine operates, sort of software running on hardware, that leads naturally to network effects of different kinds. So, consumers benefit from Facebook being connected to over 2 billion people and being able to connect with other people.
Right.
And so there's value. WeChat users benefit in the same way. Android users benefit from the fact that application developers can develop for 1 or 2 platforms. If we had 50 operating systems of phones, there wouldn't be a lot of value created in each. And the list goes on, like, users of Netflix benefit a lot from the recommendations that are derived from other users' usage of Netflix. And so these network effects are ubiquitous and value creating for consumers, but they're perhaps even more value creating for the technology firms, because they erect these very powerful barriers to entry, and they lead to what economists call natural monopoly, where the natural market outcome, and perhaps the most efficient for society market outcome, is one firm. And so there's no doubt that the power of network effects benefits firms as well as consumers. In terms of what to do about this newfound market power, I think here's where the distinction between the Standard Oils of the past and, say, the Facebooks or the WeChats or the Googles of the present really becomes salient, because it used to be, the idea was that you should not let a firm get too big. If it got too big, break it up. I think sort of like, the most storied example was AT&T in the United States, right? With these tech platforms, breaking them up is actually, first, hard to define, and 2, not in the best interest of consumers. You'll weaken the network effects, and you'll destroy value without solving any of the problems that their scale causes in the first place. So if you broke up Facebook into Facebook and Instagram, this would not stop Facebook and Instagram from imitating Snapchat's features. Right. If you broke up WeChat into multiple companies, they would each be sort of tech titans. So I think the approach that we should be looking at is to allow the monopolies to thrive, but to regulate them, to think of things like commission caps and price caps, to think of stronger protections for innovative new firms, so that the imitation of new services isn't quite as easy in the future as it is today.
You mentioned that, and I think it's a very good point, that there are different types of companies, different types of network effects. Yeah. Should we be thinking of the ad-supported model, the companies that are built around ad-supported models and the sort of engagement engine? Is that a different case from other merely big companies like Amazon?
I think that there are similarities. One useful distinction I find is between global and local, in that an advertising network like Facebook or Google, or a retail network like Amazon, which is shipping things over long distances, everybody benefits when there are more sellers on the Amazon platform, when there are more sellers on the Taobao platform. Everybody benefits when there are more advertisers on the Facebook network, right? On the other hand, there are other businesses like Uber, like Didi, like in some ways, the 58 Daojia, the local services business, where the network effects are specific to a particular geography. So if Didi has a ton of drivers in Beijing, it benefits the customers in Beijing, but doesn't add a lot of value for the customers in Shenzhen. On the other hand, if Facebook has users in New York City, it has users in LA, there's a lot of cross benefit because people's friendship networks are not geographically constrained.
I see, yeah, so some might be more durable than others.
Yes.
Maybe. Yeah. Fatoumata, you helped found Africa's first unicorn, Jumaya. It's an e-commerce platform, right? And now you run Janngo, which is an incubator, startup investor, VC type company. It must, as an investor, I'm sure you're out there looking for this sort of network effect, maybe flywheel effect, as a sign that a company may actually do well. But to what degree do investors bear some responsibility for the fact that the market does become less competitive, and are there things that we should be doing on the investment side to think differently?
I think when we look first at global situation since the middle of 2000s, we see a higher proportion of increase in intangible assets on the stock market. And it's, as you mentioned, very strongly correlated to market concentration. But we also see a very strong difference between sectors. So for instance, when you take the consumer goods sectors. You are giving the example of Amazon, for instance. It's the same with Walmart. They have been investing very strongly in intangible assets, such as business processes and, for instance, inventory management optimization. And I like this type of approach because it leads to productivity gains for the whole industry, actually, that can benefit from it. It's true that it creates competitive advantage for them, but it also decreases the productivity costs for the whole value chain. And this is the kind of things that we look at. On the contrary, when you look at the healthcare sector, for instance, you see a different phenomenon, because the increase of capital that we see globally on intangible assets is translated, I think, mainly into markup increase, right, and market power. And this is not necessarily the type of increase of capital that we want to see if we want to reduce market concentration. And when we look at Africa, for instance, we, as you know, have roughly 1.2 billion people, very connected. You know, the tech leapfrog, especially the mobile financial services tech leapfrog is happening in Africa, with more than 50% of the GDP of Kenya that is going through mobile wallets, for instance. Still, we don't have a very strong equal access to capital. And when I take, for instance, the example of my first company, which we co-founded in 2012, it was able to raise over the years roughly $1 billion of capital and being market leader in up to 33 markets in Africa. But that's exactly the same amount of money raised by the entire tech startup scene in Africa last year. So this access to capital is really created very strong barrier to entries. And I believe that, and that's actually the motivation for me being a tech entrepreneur first to become a VC investor, is when we also are able to provide a quality capital that is affordable with smart money to great entrepreneurs, they can actually have the same performance. And when you look at BATX, for instance, so Baidu, Alibaba, Tencent, Xiaomi, they were lucky enough to get access to the same quality of capital and to be able now to be a very strong group compared to the GAFA.
Yeah, right.
So when I believe the capital is put to use to increase productivity and to benefit the whole ecosystem, number one, and two, that we have access to the same capital globally to all entrepreneurs, I actually believe it can be a very good thing to fight this concentration.
So then being able to fund possible competitors that are being ignored by the system as it is now.
Absolutely.
Mr. Xiaohua, you run Daojia, as we were just talking about. You provide services like housekeeping and babysitting, which means you're not only in the world's most competitive digital market, which is China, but also the most competitive segment of that market, probably online to offline services. What is your experience in this regard? We're talking about network. You know, do you see these same sorts of network economics prevailing in China, or is China somehow different?
I can give you one example. The domestic helper industry in China has enjoyed over decades of development, yet not a single company before us had developed a scale up to 1/10 of my company. And the company was just founded in 2014. Regulators were very surprised about that because all the other companies under their jurisdiction hadn't thrived so much in comparison to our 4 years of trajectory. And now we are very active on the mobile internet with a strong brand. Actually, platform is my favorite word. Before, we also developed 58 Tongcheng as a platform for localized commerce. And now we are developing another platform for domestic helper service and a nanny service. Actually, this information revolution is defined by the boom of so many platforms. I once talked to Pony of Tencent about 58 Daojia. I said that in the first industrial revolution, factories mushroomed up. And in the second industrial revolution, we had so many office towers. And for this ongoing industrial platform revolution, we will have more and more platforms. That's a result of the choice of the nature or the survival of the fittest. We have so many instant messaging platforms and so many platforms. That would be a nightmare for the SMEs. We need just a handful of platforms to ensure connectivity.
So we use data to connect, to be connected. Also, the so-called super companies are actually focusing on infrastructure services. But for 58 Daojia, we focus on housekeeping. And for companies, they may need a consolidated or a unified system for data and for training, and also a credit rating system. So I want to build such a platform. The system will make the stronger even more stronger. So we hope to generate more value with the internet or with the platform. As you can see, companies get bigger and bigger. Their market values are increasingly large, and I believe that in the current round of information revolution, we will see companies with even bigger market values. And the second point is about how the government is going to deal with such new companies or new platforms. As you can see, the existing regulations are based on the traditional industries. For example, I was asked by the professor that if I train a housekeeper, does she become my employee? Well, in the traditional sense, no, she is not. However, I believe that actually she is my employee because in the new context, I provide the training and I provide the platform for this particular individual to seek a job. So this is the new context, unlike the context about 150 years ago. So the current working patterns are changing from the traditional ones. And of course, we need the whole society to work together to come up with something suitable for today's working styles. Thank you.
Arun has a
Yeah,
objection.
Oh no. I agree, sort of wholeheartedly. I mean,
Agreement.
platforms are. Platform is my favorite word as well. Among all the different platform words, sharing economy platform is my most favorite word. But I have a little bit of a bias there. But I think that if you imagine where does the word platform come from, right? I mean, it's something that you can stand on top of and build on top of. I mean, this is where the original notion of a platform came. And if you think about the future of the labor market, labor platforms are going to be central to individuals being able to create small businesses that have global reach, that have access to big clients, because the platform provides the scale. It provides the platform, in some sense, on top of which you can stand and actually build the big business that you want to build, whether it's selling through Taobao or whether it's running a small sort of household work service through sort of 58 Daojia. It's sort of it's incredibly empowering. And so I think that as we think about how should we change regulations, because I also agree with Mr. Chen that we're trying to fit sort of square pegs into round holes often with sort of the new business models and the old regulations. So beyond antitrust, beyond sort of anti-competitive stuff, I think there's a much broader conversation about how should the regulations evolve to accommodate these platform businesses that don't look like the businesses of the past, but are empowering individuals without making them employees in very different ways.
Can I challenge you a bit on that? I mean, you can build value on top of maybe Amazon or Taobao. You can't necessarily do that on Facebook or Google.
Yeah, I think that, again, that's why sharing economy platform is my favorite word,
Right.
Not Facebook platform. And, it's not all of them were set up to empower the individual. Okay. I mean, Facebook is taking my attention and building an advertising model on it.
Right.
But, Google would argue that they are empowering millions of small businesses through their advertising network to sort of reach a global audience. It's a different kind of empowerment. It's more access to consumers rather than providing of capabilities. But with Amazon, with Taobao, with Airbnb, with 58 Daojia, it's a different kind of empowerment. I think what's critical to keeping inequality low is that the platforms allow the individual to actually own some of the capital, to own some of the business instead of making them on-demand labor.
Jessica Tan, co-group CEO of Ping An. At risk of prolonging this platform is one of your probably favorite words as well. You have taken what was a pretty, or helped take what is a pretty basic insurer and moved it very aggressively over the last 5 years into digital, into the digital world. You have, I think I read 500 million users of all your platforms. You probably have almost a dozen platforms
500
now.
million, half a billion.
500 million, that's what I meant to say, 500 million. And maybe a dozen, 11 or 12 platforms now. So you've come into an arena that has some pretty tough competitors in terms of Ant Financial, for example, or Tencent. What is the lesson that you take away from that, or just about how to encourage or enable competition in these areas?
Yeah. So I think I take it that I'm representing kind of one of the incumbent traditional companies on this panel, and what do we do in face of that, right? And I think there's two ways that we look at it. The first one is that one of the things that you lose out basically as a insurer or financial services. I mean, basically for those who don't know, we are an insurance company, financial services, and we're one of the largest in the world. And in the past 10 years, as Andrew mentioned, we just invested a lot in technology. And there's two ways that we kind of look at this. I think the first one is actually one of the things as we looked at 10 years ago, displays or internet, et cetera. One of the things that we lose out on as a company or traditional industry is then customer interactions, right? And this is natural, right? As people spend more and more time on their smartphone, on their internet companies, we lose the interaction with them, right? And then with the interactions come with the affinity to the service and therefore the data and everything else, right? So what we did was in basically the first stage was we have to first transform ourselves. Right, we got to be much more efficient and effective in doing so. So invested a hell of technology to ensure that we are on par at tech level with the internet companies. And we grew from, I think 10 years ago, 3,000 developers to now 30,000 developers, 99,000 people in the 11 tech companies that we've created over the past 10 years. That's one part, right? We're just gonna make sure we're on par because otherwise we're on not the same level of field. The second thing we gotta do is then, within we are thankfully in vertical industries, financial services, we're in healthcare, auto, smart city. They're a little bit more regulated, so we have a little bit of time to think about what is it that we do. And I think while seeing the trend that I think Mr. Chen talked about, this disintermediation and stuff, we got to think about how we redefine the whole ecosystem. So one of the things that we did was that I'll give an example in, let's say, healthcare. Right? As insurance, we're typically at the end of the value chain, right? People come to you when they're sick or they're dying or they're dead. Not a very good business to be in if you want to be in the healthcare business. So we got to move upstream, right? So today, we looked at that whole healthcare ecosystem holistically. It took us 10 years to do so, whereby I think not only do we want to be the person paying for it, we're the largest private health insurer in China. We have a company that actually serves the social health insurance, so we control all the end. But we actually created a startup called Good Doctor, It's the largest health portal in China right now. It's an app with 250 million users, and by far, I think the number 2 to number 9 traffic add together is a quarter of ours, right? So you have people, 550,000 people every day asking our doctors about what they should do about health queries and stuff. 75% answered by AI, our chatbots and stuff. So I think that was the first part of then trying to then link a direct relationship with the consumers who ultimately make a decision. And then that's not enough. We got to move next part to actually controlling. If you want to be in the healthcare business, you got to be able to control how the quality of care is being provided, right? And in China, we are talking about providing for 1.4 billion people with only 3 million doctors, over tens of thousands of hospitals with very inconsistent quality. So we used our knowledge of the health tech and then created these tech platforms that we actually serve the hospitals. So over 3,000 hospitals use our AI medical imaging today. They use also our clinical decision support system, whereby it can help the doctors. I think we had a competition. I mean, if you take a GP of the streets, I mean, they get 51 marks out of 100 in solving for various diseases. And then with our tool, they could get up to 88 marks, right? Because the AI engine was actually trained the best doctors, real life cases that a normal GP wouldn't be able to get to. So I think this as an example, I wanted to share is from an incumbent standpoint, right? We could look at all these disruption and say, okay, we got to put more regulations, et cetera, to protect ourselves. But I think 10 years ago, we decided to embrace it in some sense, right? And actually take time to build up capabilities where we can continue to add value, right? Where insurance, you're at the end of the value chain, we don't want to do that. We wanted to move upstream, whereby we build trust with the consumers directly, in a very vertical basis, so it's much more specialized. And not only that, you need to link, a lot of people think internet platform is just about the consumer front, right? I think the second part I mentioned is very important because it's all the rage about online, offline. It really makes a difference because even the most disrupted industry, I mean, retail being an example, right? And China being the most disrupted in some sense, less than 15%, the last I checked, are actually digital. So in that sense, I think you really need to ensure the people who are actually delivering the providers. I think what you were saying about tons of these SMEs and others, right? How do you then bridge the gap, right, between where the consumers are? And we see a role for ourselves because having been in this industry, as incumbent, whatever industry you have, we've accumulated over decades of doing work, specialized knowledge, right? In financial services, it's about risk management, right? In health, it's about the medical knowledge, right? So we decided to take that, instead of just serving them ourselves, we take that and package it into tech platforms in the B2B way to the other providers, empowering them to serve the consumers, right? And we believe that this is how, when we talk about ecosystem play, Ping An believes in that. We've done that in healthcare, we've done it in financial services, we've done that in auto as well. It may disrupt our own business at the beginning, but we ultimately think this is a good bridging way, especially as you come to more complex services and products that you deliver. So I think that's kind of where I would come from.
So you have data and money and experience and
yes, that's right.
Find your way in.
That's right. And I want to just comment a little bit about monopoly and stuff, right? I think the concept of monopoly is not new.
No.
It's not, right? Because if you think about this, yes, we're in a digital world, so the way we think about assets is different, right? Because data is a beautiful asset. It's not like railways or telecoms infrastructure is reusable, and you can't see it, right? But it's the same concept, right? So I think the way to deal with these things is a natural thing that happens, right? As you accumulate more, due to their really good services, like what Mr. Chen had talked about, right? They accumulate data, which are valuable assets, right? Just like telecoms. And the way to do this is not saying, oh, you're evil and you should break it up. But I think ensuring fair access to everybody, right? Just how telecoms industry have done, right? The whole point of, I remember 1-2 decades ago, we talked about MVNO, right? Whereby, look, you used to be a monopoly building all these regulated industry, that's good for you, but let's also open up for more innovation so that everyone should have fair access to the infrastructure, but you can create different things, different mobile virtual operators on top, right? And I think it's the same. Right, and we got to figure out.
So you're suggesting like access to Facebook's data or access to Tencent's data?
Yes, you absolutely should open up data access to that, and then it becomes a fair level playing. To your point on how you monetize this, right? Then it's up to everybody how you want to monetize this. I think the difficulty here is that in reality, many of the regulators are just catching up to this idea of how you would make it open, right? Because it's not just say, oh, you got to give your data opened up, right? Because you then have to have APIs. In this respect, I actually think in our global right now, I think Europe is actually leading in many parts of these. They're talking about opening access, not just for data, but all your products and services have to be on open APIs, right? People got to have free access to that. And I think that probably is the right way to frame it so that it doesn't compromise some of, because they are producing good consumer value in many of these platforms. That's why they exist in the first place, right? So without breaking it up, I think you can come to a more moderate sense.
Can I jump in?
Yeah.
I agree. I think that 2 decades ago, in the telecom sector, this notion of an essential facility, like you need this in order to operate a business, was a topic of hot discussion in the United States, and where the local telephone providers had to open access to their local networks to anybody who wanted to offer local telephone service, because they couldn't go ahead and build an entirely new network. And I think that it's a good parallel, but it's going to take a while before. I completely agree with you that something akin to opening access to facilities necessary for commerce. If we decide that Amazon's platform is necessary in order to be an online seller of any kind, access to that platform is necessary to be an online seller of some kind in the United States, or access to Taobao is necessary to compete as a small business in China, then access to that platform, to that essential facility. The thing is that when you get into data access, you have this trade-off between, it's almost like, sort of this three-pronged problem. You've got user privacy on the one hand, you've got the intellectual property of the platform on the other hand, and then you've got the broader social good on the third hand. But a point that you made earlier that I really want to agree sort of wholeheartedly with is sort of in some ways the innovation incentives that scale creates, right? I mean, what you were talking about in terms of developing new technology for healthcare. In many ways, when a platform has that kind of scale, it allows them to innovate, but also vertically integrate. In some sense, you sort of go further and further back. Mr. Chen was talking earlier about training, sort of creating sort of the pipe of small businesses that will then sort of operate on his platform. And that sets up a different kind of trade-off for the regulator, which is you want to encourage innovation, and you guys are in the best position to innovate, and you've got the resources. But on the other hand, then the company starts to sort of get not just broader, but deeper. And what are the controls that you have to put in place to ensure that other people can innovate as well?
And I think it's also interesting to look at it in the context of emerging markets, right? So in that context, platforms have been enablers of very strong value to end users. And it's very similar to what you're explaining, for instance, in China. If I take a look at our e-commerce platforms, the reason why it got so popular is when you look at the numbers, you have, for instance, in the US, 1 retail outlet for every 400 inhabitants. At the same time, in Africa, you had 1 retail outlet for every 60,000 inhabitants. So it has the opportunity to really level out the playing field in terms of access to goods that are affordable or qualitative to end users. And we tend to look at maybe the issues around platforms with a look on competitors of the maybe main leader, not necessarily to the benefits of the end users. Another example is SMEs. So when you are SME in Africa, you have so many issues to be able to trade. And there is no surprise why we only account for less than 3% of global trade. When I try to break down these issues, they are in all the value chain. First, you have an issue accessing funding, because most of the SMEs are like informal, so they are not necessarily registered. So it's very tough for traditional bankers to be able, for instance, to appreciate their working capital needs or their business solvencies. And here, for instance, I remember that I started having fashion designers on my platform in Côte d'Ivoire in 2014 because I identified a market need. But to bring them on board, I had actually to give them working capital advance. And it worked so well that it actually became a new business model for us, lending working capital and financial services to SMEs, because we're not only creating a kind of credit scoring for them, but enabling them to have a track record with what's the history of transactions made on the platform. It's the same with logistics costs. For instance, in Africa, the cost of moving a good from one place to another globally can be as high as 75% of the cost of the goods sold ultimately. In the US, it's like 6 to 7%, the cost of logistics compared to the cost of the good. So when you have, for instance, and it's one of my portfolio company, digital freight platform that brings this cost down, you actually level the playing field of access to global trade for the African SME. So it's very important that we not only look at the effect of the platform's concentration with other competitors. Of course, we can find ways to mitigate it, regulation included, but sometimes you also can have non-intended bad outcome of well-intended policies. But it's also good to look at what is the ultimate value that it creates in terms of access to essential services for the many, access to healthcare, education, financial services, access to trade, access to capacity, access to funding, and I feel that it's very powerful as a thesis for emerging markets, and it's actually my investment thesis for Africa.
You know, in so many ways, I think the opportunity for SMBs is going to be maximized if we create these gateways to platforms. And you know, to me, that's a proactive thing that governments and regulators can be doing, because in many countries, it's easy for a small or medium-sized business to access the platform services. In many countries around the world, either because of like, you know, education levels or because of like, you know, digital access, you know, a significant fraction of individuals or small and medium-sized businesses do not have the capability to connect to this value-creating platform and reach those global markets. And it seems like we need on-the-ground operations that sort of allow these sort of trusted intermediaries in some sense at the local level that could come from the government, could come from the community, that sort of act as a gateway for these individuals and for these small and medium-sized businesses to sort of access the logistics, the financial services, and the global markets that your platforms are creating.
I wanted to build on, I think, both the points, because I think this does mark a little bit different in the internet kind of digital evolution, right? I think at the beginning, people think of these platforms more as the front end or selling stuff, right? I mean, in the context of SMEs, et cetera. And I think increasingly, so that's why if you look at the value chain, typically only one part of it is being disrupted, right? People maybe do one part of it, but the rest is still completely offline, completely divorced from the world. And I do think that increasingly, technology makes it much easier to do the rest, right? To get the rest of it up, right? So I mean, if you talk about SMEs financing, for example, and it's redefining what we mean by platform. A lot of platforms are more B2C in nature, but I think it's redefined. There are now platforms whereby it serves businesses in some sense. So for example, one of the things we did last year was a blockchain trade finance SME platform, right? To your point about SMEs getting access to financing, et cetera, right? Which, you know, forever they are not able to do that, right? The technology now makes it so easy for blockchain. I mean, they can just deploy a node on their whatever systems that you have. Well, of course, it needs a little bit of, you know, slightly bigger that you have systems. And it's amazing, 21% of the SMEs who went on the blockchain platform voluntarily authorized their data to be shared on a real-time basis.
Oh.
And this is data from their transaction POS information, their finance system, a CRM system, because I think this shows that everyone, you recognize the information asymmetry, and then now technology makes it easy for those who are good players with good credit, share that voluntarily, right? And then what we do as a platform, of course, we take that raw data, build lots of models around it, because I mean, we're used to giving credit and stuff, and then make access to, you know, 40 over other banks and financial institutions who can then, based on this, give credit, right? And the amount of financing costs can go down by 20, 30%, right? But I give this example more as I think it's complementary to what, you know, you just say, because I think the first phase was really about making people easy to sell and acquire customers. That's what people think about. Yeah. But then there's still a long part of the value chain there that's completely unsolved, right? But I think increasingly with, you know, technology being now much more scalable, instead of building like huge 10,000 people offline, because not everybody can do that, you know, get offline, you're able to gradually move that part of the value chain up as well. And I think then that will really come the big big push, right? That's, I think, when you will see kind of sectors, not 10%, 15% being digitally disrupted, but I think the whole thing being completely uplifted. And that's very exciting, I think.
And this is some ways why the conversation about regulating big tech is often so frustrating, because it's couched in the language of break up the big tech companies.
Right.
It's sort of this antiquated notion that if you get too big, it's bad for society. And if we do go down that path of saying, well, these companies are too big, we have to make them smaller, we're going to leave all of this immense value that we've been discussing on the table, and we're not really going to gain a lot in. So I'm not saying that we don't need regulatory oversight, but the lens through which we should be looking at it is in, like, what is actually harming competition and harming consumers, and what is actually sort of facilitating value. And everything that I've seen seems to suggest that scale does encourage innovation and facilitate the creation of value.
You just have to turn it into an actual platform, maybe, on which people can build more value.
Like, some openness, some curbs on imitation of, like, maybe Instagram should not be able to seamlessly imitate what Snapchat does. And, you can extend the laws on tying products in an easy way to sort of prevent that kind of behavior. Maybe some price caps if platform commissions get too high. If a platform is taking 80% of the revenue that is flowing through it, then you sort of say, well, maybe market power is being abused.
Or 30%?
Well, I'm not going to get into the exact numbers here, but I don't know what platform you have in mind when you bring up 30%.
Any.
Yeah.
And another issue about talking about regulation only is we take a threat approach, right? When we could also take the opportunity approach. The examples that you have, that you just shared, I have so many other examples like this in our current portfolio. So for instance, in East Africa, we invested in a tech startup in Kenya. Basically what they do is they buy from farmers directly, and prices are 10% higher than what the farmers would get through 6 to 7 intermediaries. And they sell directly to small sellers that have mom and pop stores where the end consumers will come and buy from, in the street, basically. And those guys also access their products at a 10% discount because, again, they have intermediated the whole value chain. But why it is even more exciting is they do so decreasing the amount of food waste that was produced. So on average, the same value chain had 45% food waste, but they are at 10% food waste. And now, because these farmers have a track record, we are actually able to develop funding pilot to be able to finance their working capital. And I would like to see more capital actually being very mission-driven and looking beyond the capabilities of just bridging a gap between supply and demand and seeing all the positive externalities, not only as externalities, but as the core of the investment thesis. And we see also that it's, for some of them, we call it impact investing, but it's not only about impact. It can deliver the same rate of returns as, commercial-driven approach, but it can also do more and solve some market failures that are very strong in emerging markets in terms of access to infrastructure, access to finance, or even access to labor. And I think maximizing the opportunity is as important as working on minimizing the threat.
Actually, I wanted to go real quickly to a question from the audience. I think we have one here in the front. We have a couple, actually. We'll go you and then you. Yeah, go ahead.
And talk about the monopoly of platforms. I think nowadays it's different than before. It's internationally, globally, right? And recently, Chinese scholars really rethinking about these issues. For example, there's a Huawei issue, right? And the one order, just a U.S. Ministry of Commerce, of one order, make a whole Huawei phones cannot use it for Android, and suddenly become useless. And that kind of regulation, when you talk about regulation, one country regulation, one country elected for their own country's interest, maybe right away block other countries' interest. So that kind of platform, that kind of monopoly, how can we address it? And that become now a lot of Chinese scholars nowadays rethinking about what we are so optimistic about globalization, technology, but now we're really scaring for that. Thank you.
Yeah, who wants to take that on? Because there's obviously a big political, I mean, you'd
Yeah.
mentioned European regulations and yeah.
Yeah, well, you know, it's a really good point, but I think it's one that's unlikely to repeat much in the future because it's occurred. You know, because now Huawei has been sort of cut off temporarily from accessing, like, you know, the Android network and Google Play Store. What's going to happen very rapidly is that a alternative to the Google Play Store is going to emerge, driven by Huawei. They're not going to lose much of their 30% plus of, like, you know, sort of the equipment market that they have. And in the future, you know, because of the fact that you don't have one dominant country in the world anymore, I mean, like, you know, counterbalancing the power of the United States in tech is the power of China in tech. And so it's hard for me to imagine a scenario where 10 years from now, there is a third country whose companies are being cut off by both US platforms and by Chinese platforms. So if one country takes action, you know, the third country will have access to the second country. So, like, you know, the fact that we've got sort of the tech powerhouses in China and the fact that this has happened will lead to the evolution and the emergence of parallel ecosystems that will certainly make sure that Chinese companies don't face this from the US and vice versa in the future, but also makes it very unlikely that companies from a third country are going to sort of be cut off by both axes of power.
Xiaohua.
我觉得这个问题特别有。
I really like this question. It's very interesting because the national policies indeed are platforms. Now we have a market economy, which is a platform, and the Huawei example also shows that there are competitions which are very fierce among the platforms, and for different country systems or political systems or cultural traditions, there are also competitions. You have Amazon, we have Taobao, you have Facebook, we have other platforms. So talking about monopoly, I believe that so long as the human civilization is diversified, we will always have such kind of different platforms or different competitions. For example, if Didi is very successful, and then on the second day, it may find its potential competitor in the market emerging. So my point is, today we are talking about the shared economy, and for me, previously when we talk about countries, we wanted to adopt market economy, and in companies, we also have the market economies. We have CEOs, CFOs, and etc. And in the market, we also have the market economy. We have Didi, we have other car hikers. So indeed, there are always changes, and we always have new players in the market and new platforms. So I believe we should have confidence in the government for coming up with new regulations, sound regulations, and also we should have confidence in the human civilization. Also, talking about the platforms, whether the platforms are successful is decided by the number of players in the platform. Take ourselves as an example. Can we become a powerful player? I think it depends on the platform that we have built or we have helped to cultivate. So we can enjoy a sound platform and a sound system.
There's a lot of competition, and actually, let's just go to. Can we go to one more question from the audience real quick, and then pick up on that?
Okay, so thank you. I'm from Caixin Media, and I have a question about a future model of data. Because we know the problem is that today the data is generated by users, but the profits actually mainly go to the platforms. And we see that a few days ago that Facebook released the Libra white paper, and most people focus on its financial meaning that it will become a new way of payment or a new world currency. But very few people mention that this Libra could be used as a tool for Facebook to establish a decentralized user data trading platform that, like, if I authorize someone to use my Facebook information, I got paid, or I upload my credit information, I got paid in terms of Libra. I don't know if you ever think about if this could be a possible, broader picture of Libra that Facebook could, give back the rights of the data to its users. And do you think this model will prevail, in today's, internet economy, platform economy? Thank you.
Jessica, this sounds like your territory.
Well, I won't comment on specific Libra or not, but I think I wanted to comment more generally about how do you ensure level playing field, right, in the digital economy, where something are similar but a little bit different, right? And I think there are three things. If I were a regulator, I think I'll focus on three things. I think the first one is that for these intangible assets, data being one of them, as I said, you can't see, yet it can be reused, and the person doesn't even know. You gotta have rights around it. Rights about who you gather it from, what you gather, and what you use it for. Actually, it's not just me signing, say, yeah, you gather a bunch of it, but what are you gonna do with it? And I think rules needs to be set around that. It's the same like any asset, frankly. We're just a little bit behind, right? If you go purchase a house or anything like that, right? Any other asset, you have these rules around it. So I think that would be number one. We gotta start defining around these intangible assets, rules about gathering and using it. I think two is then about access, right? So once assuming that every piece of data being gathered, the person knows what has been done and what it can be used for, then you need to make sure that the access is being provided, right, to not just the person who take it, but it's others. Because this data is not just the business who collected it, it's both the consumer and the business, right? And I think this is one use, actually the blockchain for me is one idea that can be done, because, not so much in the series of cryptocurrencies, but the concept of having different keys, right? I can always imagine that's a consumer level key and a business level key, or even government level key. There are different keys in order to make sure you unlock it, right? And then you can use it. So having access, right, with the equal rights, I think is the second thing I would do. And the third thing is then the activity itself, right? One of the things that lines are blurring is because people can be doing financial services without actually getting a license for it. There was a reason why it's licensed, right? It's like practicing, right? If you're a doctor, right, and you need a license, right? If you want to lend money, there's a license because collecting deposits and then taking that and give it, which is the most traditional business of bank, requires license because you want to make sure people know what they're doing. Otherwise, lots of depositors will lose their money. And I think this part, a lot of it, because a lot of the large internet companies dabble into many, many things, it's not so clearly kind of envisioned, right? And so I think it needs to be, we should license by activity, not people. Any company in whatever sector, if they do the activity, then it should be governed by the same set of rules and licensing. It just makes it more complicated for regulators to do, because then suddenly everyone could be engaging in that. But I think if you stick to these three rules, whether at a country level or multilateral, I think the question about cross-country, frankly, that's why we're multilaterals, defining these rules, if you will, then I think you can let it evolve, right? I don't believe, the only thing I will kind of believe, I do agree with Mr. Chen about a lot of the benefits and that you have to have value in order to sustain. My only question, I would take a more moderate stance in that I do strongly believe the role of a regulator, because it could be a while before it catches up with them. And a lot of abuse could be done, right? I think you can see in China some of the less run and regulated financial services, kind of like platform, P2P kind of going up, because they don't know what they're doing, right? So I do think that regulation do need to catch up to ensure that it kind of creates it in an orderly manner. Yeah.
There is a bit of tension between scale and financial probity, right?
That's right. That's right.
We had a question over here.
I think the question is not trying to force regulation, but look at technologies that are going to lead to a certain level of transparency. My personal data is being used by a company that takes advantage using two-sided markets to make a profit. Now, technologies like blockchain and zero-knowledge proof are getting us to a level where they can verify independently if your algorithm, without knowing what the algorithm is, using my data without knowing what my data is, and that proof can be provided by a third party. If this information was available, then what the regulators can do is that every part of the process, my personal data is being used to monetize a company and what is the public good that comes in. And then the traditional mechanisms of taxation and profit sharing and others can come in. Rather than going like in a full hog with regulation, we need to give these technologies the time to provide that transparency in who is benefiting and what part of that benefit is public good. And I think that's where we need to be heading.
Yeah. I fully agree with that. It's just, unfortunately, it's a very complex, in principle, I fully agree. It's just, it takes time to work out the mechanics, but I do believe you should use technology to solve this problem as opposed to suddenly restricting access, right, and going all the way backwards, yeah.
It just seems likely that we're at least a decade away from a purely decentralized version of what you're referring to. I mean, whether it's like, you know, maybe this is where Facebook's Libra will come in, because they're a trusted, you know, at least semi-trusted branded platform. It's not just like Bitcoin where there's no sort of party for accountability. Right. And so it's possible that they could start to make a market for this kind of activity. But in many ways, I think this will temper the power of governments. Sort of going back to the first question, in some sense, I mean, like, you know, we're not going to see too many more of, like, you know, the ability of a nation state like the United States to be able to play this game of trying to stifle the power of a company from another country because it's becoming too powerful, right, will be tempered by the fact that in 10, 15 years, decentralized systems, but even today, sort of large platforms are increasingly sort of taking on these government-like regulatory roles. So essentially 3 more US election cycles. Well, you know, I'm just sort of holding my breath for the next one. You know, that's, cool. Any more questions from the audience before we? All right, well, thank you. I guess we should, I think we should wrap up. Arun, Fatu, Xiaohua, Jessica, thank you so much for your time. In terms of lessons, I found you all surprisingly open to regulation. The idea of sort of digital utilities hadn't been one that I'd expected to come out, but it's all very thought-provoking. I think also this idea that the platforms and the scale create a lot of potential value that, you know, should be used rather than regulated away is something that we should probably all consider. And then, of course, we should remember that not all platforms and not all network effects are the same. So thank you very much for your contributions. Thank you for your questions. And see you all soon.
Thank you.